Hey everyone, welcome to the Diff. We are excited to be back after a week off. This is an Energy PM's take on the world of energy and energy investing. I am John Riley, joined as always by my partner in crime, Greg Bordelon. Greg, we were gone 2 weeks and holy moly, what a lot of stuff happened, man. I was basically skipping into the office today. I don't think my heels touched the ground. That first topic we wanted to talk about, M&A, and oh man, is the world not disappointed. On our first episode, you talked about the CVX PDC deal and how you thought there was a chance that it had pinned the valuations of the M&A world for shale at perhaps a roughly 3 times multiple. And we've seen 2 deals now, SD and Nogue taking out Novo, and we now have last night, oh man, it makes me giddy, Civitas with a $5 billion deal to take out NGP's Permian assets. And I couldn't be happier. As I've mentioned on this pod before, and some of you know, I started in distressed and high yield, and to have a debt-fueled shale M&A acquisition. And then I'm smiling ear to ear when I saw that equity was only going to be 20% of the financing on that sources and uses table. This is so old school. This officially takes us back. And I just couldn't be more thrilled. I couldn't be more thrilled. I think one of my to-dos as I have time over the coming days, I might have to sketch out a debt for equity exchange, in advance. Apollo owns 2/3 of the bonds and takes a 1.5 lien and a pick second with warrants for 20% of the company, put it in a time capsule, 24 to 36 months later, see how close I get. I mean, this is just fantastic. So I'm obviously over the moon. I just wanted to kick it to you. Your thoughts on what we've seen the last couple of weeks, valuation-wise, basin-wise, and then we could have a discussion really of the implications for the shale space going forward after these 2 fantastic deals. Sorry, I'm so excited.
Yeah, I know, man.
I just can't wait for these bonds to trade at 30. It's gonna feel so good. It's gonna feel so good.
Last night there was the rumor, right? The pre-release rumor that they're nearing a deal, and you and I were texting on it. And I was wondering, how are they gonna get NGP to take this much of their paper? And of course, the answer was didn't have to do a lot of paper because they're debt financing it. And I didn't even think of that because you haven't done that in 10 years. We rewound the clock 10 years, and I'm still kind of flabbergasted by it. So I guess I was excited last night, but I was concerned that a deal was going to come this morning and be kind of cumbersome to work through, but it's not, because it's a mirror image of the prior 2 that we hit with the last month. So now, round numbers, the last month we've had $15 billion of E&P M&A deals, which I think you can take to the bank. Those are real markers at this point. It's 3 deals.
$5 billion deal is a real deal. I don't care what industry you're in. Totally it's a real deal.
Especially in this space, which is relatively small cap on an infinite basis. So we had CVX PDC, we had the Northern Oil and Gas Earthstone combo deal for Novo and the Permian, and now we have Civitas for this double Permian acquisition. The numbers are bad, right? Like we flagged it with PDC. This stock was getting they were selling at 3 times, and I had to check the math a few times that day to make sure I was looking at everything, and then I had to do some digging to figure out why on earth they would accept a deal that sold the company at 3 times. But that's the new norm, and we kind of raised that risk before. That is this a one-off or is this the new normal? And it's the new normal, as confirmed by the last 2 deals. I thought perhaps when PDC sold, it was because it was in an anomalously weak strategic position.
Mm-hmm.
Where they hadn't been able to grow organically for years. They'd been buying their growth and running out of room in the DJ. So maybe that forced the low valuation. It didn't seem like that was the case, but that was a potential. And these last 2 deals have confirmed it. So real quick numbers. You had the SD Nog consortium buying Novo in the Delaware last week for 2.7 times EBITDA. $9 a barrel on crude basis, and call it 44,000 per flowing. BOE. And then today, you back into these deals getting sold, or Civitas is acquiring 2 Permian companies, one in the Delaware, one in the Midland, for a combined 3 times EBITDA, mid-40s, $1,000 per flowing barrel, $14 approved barrel, and free cash flow yields that look a little different because of the debt financing here. But this is the new normal. It's not because they're the sellers are in a disadvantaged basin like the DJ. It's not because some weird structure. This stocks or assets are exchanging at 3 times now. When you think about this and you paint with a broad brush these valuations that we have seen now in the Permian, which was supposed to be the premier basin.
Yes, it is.
It does speak to some serious disparities between public and private market valuations.
Oh, it does. And you brought up a good point. You mentioned it in the first pod. Is PDC selling at that low, what was thought to be a low multiple, because they're in a basin with high regulatory risk? If you're not already there, you may not want to enter. Chevron's already there. All these different things. We're now talking Permian, the one that's been spun to every equity investor across the globe as the gold standard, the basin where everything will happen. And I don't know how you necessarily, as a public equity investor, reconcile what you're paying by and large across the space versus where these deals are moving. And obviously, if Civitas, not the largest market cap company in the world, if they saw the deal, I can't imagine that the big boys, the bigger shale players and the majors didn't see the deal.
Yep.
I can't imagine that they didn't get the deck and are finding out this morning, oh, that was available. I mean, so at these deal levels, you're obviously having stronger players pass on them. And again, I know there's acreage considerations and who's exactly where and who wants to be contiguous. But at 3 times, those are the types of multiples which people would say, oh, well, it's so cheap, even if it wasn't a perfect strategic fit. Well, obviously, it's not cheap enough for the bigger guys to come in and for even the medium-sized guys to come in. And so I think it's speaking a lot to the expectations, and I think a lot to a topic we spent a lot of time on our last pod, the gas and NGL problem in the Delaware and in the Permian. And so we talked about NGLs, and they had a very rough run after our pod, even after they'd already had a bad run preceding our pod. And so I think we're going to find out that people are saying, look, I have to put a much higher discount rate on these cash flows, much higher discount rate. Yeah. This whole, hey, energy is now safe. Energy is just at maintenance mode and just going to clip coupons. We've seen it get proven wrong by the dividend cuts. We're going to see share buyback reductions. We've seen debt balances grow, share counts grow. And this is the final nail. And so I think when I look at this space and say, okay, if we stay here, if we continue to have weak NGL prices, if oil doesn't go to 150, like the bulls still want it to happen, we're going to have companies that are going to need to reshuffle the deck chairs. Fang's been hung with what it's called its West Permian. Like the real estate brokers invented the phrase Dumbo in Brooklyn about 30 years ago to up property values. I guess we're going to try to call the Delaware the West Permian and see if we can get more. But we've got guys like that. I don't think they're going to be the only one that needs to sell assets to keep dividends going and keep the game going. So I think if you're looking at this space, one of the key things you're going to have to sharpen your pencil on is moving assets isn't just a done deal. And if your thesis on a particular name is, oh, they're going to do X, Y, and Z, and I'm going to move the share price from A to B, you better plug in 3 right now. Yeah. You better take that asset and plug in 3 or whatever it is, $40K per BOE. And if it doesn't work there, I'm not saying nothing can work. I'm not saying there isn't any acreage that's special. And I'm not saying that whoever you are isn't better at figuring that out than the rest of us. But unless those are the types of numbers you're plugging in, you better have a very, very high rate of return expectation in this space. That's the big implication I take from it. What do you think?
Well, I've got a few, and I want to bounce them off of you. First, at a high level, today the disclosure on the acquisition from Civitas was kind of muddy, but you can back into enough to be dangerous. And I think you'll appreciate this. I sent you some of my numbers that they spent $5 billion buying assets at 3 times, and it wasn't accretive.
I know. I love it. I love it.
That's brutal, man. Now it is on a per share basis, but only because they're levered the hell up to buy these things.
It's amazing how that works.
It's a lose-lose here. Like you're playing with fire. And then coming out of Novo, I had done the exercise. I was taken aback by the low purchase price for Novo's assets in the Permian. You start dropping that valuation into some of these guys with all or some decent Permian exposure. The mark you're left with on the non-Permian assets for these companies, we're talking 10, 12 times. And I'm just here to let you know that there is no E&P that trades at 10 to 12 times. I'm just like a lot
not at these TEVs. I've had this conversation with many people. There's the chart guys all want to rotate into energy, and it's a PE multiple game, but it's also an enterprise value game, and commodities and energy is no different, tend to work at high multiples with very low enterprise values. When everyone's hates the hell out of the space, it looks like it's losing money. They've beaten the hell out of these companies, and your enterprise value has shrunk, and you are taking working capital out, paying down debt, and all of a sudden your enterprise value is low, and then the dynamic flips, and it looks like you have a low multiple, a low enterprise value, and they go. Up here at these enterprise values, people are paying high multiples. You mentioned, your resultant mark is 10 to 12 times, and you're already at very high TEVs.
Yep.
And we've already wasted every check that Vlad Putin sent to Texas. Every check has been blown on share buybacks, not paying debt, believing in the BS of maintenance CapEx, believing that you're not over drilling, just buying the same lines, hook, line, and sinker that we did in this space for last decade.
Yeah.
We're back. And Civitas proved it today. Like, got a banker going, hey, you know what? The high yield guys will take this. Awesome. Great. And, I was looking this morning, my energy high yield OAS which all the last decade, we all live with it. It was the biggest part of high yield, but the worst. And It was above the average market, and would shrink down and then blow up and then get close. It crossed below the average energy OAS at the beginning of 22. And the reason is because there's just not that much paper anymore. Guys either restructured or paid down, came out and got up to investment grade or what have you. There's a thirst for it, and they're taking advantage of it. But again, that's sowing the seeds of your own demise on this. And so I think that if someone in this case is saying, here, have this at 3 times, I think the NGP guys are doing a jig right now. I mean, they are absolutely high-fiving, low-fiving, kissing babies, doing everything they can to let's just get this deal closed. These guys think they bought it 3 times. Now let's move on and do the next one. I mean, I think that's happened here so much since we've had all this euphoria around O&G in the last couple of years that the private equity guys have just tagged the public equity guys. And I don't think that this is going to be any different. I'm sure there are all sorts of memos and banker notes for, a DJ acquirer, why you have to get in the Permian. And there hasn't been an M&A deal in history, not just this sector, any sector, where you can't figure out some way to spin it that it's strategically important. But at the end of the day, you're buying assets with low 50 oil cuts after you've been drilling a lot.
Yep.
That oil cut's going to go down over time, and you're betting on NGLs and gas in a region where capacity is constrained. And we've both been relatively positive, all things being equal, on that gas. But the Delaware, and especially, and the Permian Basin have a unique set of problems. And none of the rigs that have come out are going to affect NGLs. Haynesville's dry as it gets. So, again, there's no law that says public equity investors have to care about what private equity investors and where private market multiples transact. But as we stay down here, assuming we don't get a rip in oil and assuming the BOEs stay down here, companies are going to have to start selling assets. And if this is where we're starting, that means the next round, it might go even lower. And all of a sudden you're sitting here going, man, how did I think that a shale company with an ever-growing CapEx profile was worth 30, 40, $50 billion?
Yeah, and that's kind of, what I'm wrestling with, man, as I zoom out to 30, 50,000 feet is the resource capture is done. The resource upside seems like it's done too. And the inventory that these guys have been advertising is a fraction of what it is in reality. You take the resource, the inventory years that they give you, cut it in half. And if you want economic inventory, cut that number in half again. These guys are on borrowed time, and the treadmills are ramping, especially after last year when they accelerated. It's tough. I use this pithy phrase of the E&Ps now, outside of a handful that have some idiosyncratic advantages, you have to decide to buy, sell, or liquidate. PDC sold. Civitas couldn't sell now because there's no natural buyer. There's only one company that I can think of that's actually liquidating. So these guys are all shuffling the deck chairs on the Titanic. They're having to buy assets at multiples that they think represent value, but they don't. These are 3x companies. And there are only, from what I can tell, there are only 3 thematics that garner you an above average multiple. And you need an ungodly amount of acreage, some kind of new fancy business like a carbon business, or mega outsized exposure to big projects, offshore or international. That's it. Everything else is converging to this number.
Yeah, absolutely. Absolutely. And I don't see what's going to stop it. Obviously, absent a geopolitical event to reprice the deck on gas and oil and make people think it's sustainable. But the pitch to get this sector into more stable hands, to become a mutual fund friendly space, to be a long only friendly space. We're going to have conservative balance sheets. We're going to have stable and growing dividends. We're going to be shareholder friendly. That's gone. And I think this type of deal kind of does it. It's all right, guys, let's just, we can't go to the mutual funds and sell this thing. Our bankers are telling us they could tag a high yield mutual fund with 2.7 via paper. Let's just do it. Yeah. Let's just bite the bullet and let's just go back to what it was. And these high yield guys will buy it. We'll stick them with it. And then when this 2 years from now, when we can't make a coupon, we'll just negotiate with them and figure out what it is. And, we'll just do it that way. These guys are starving for it. They've been watching the equity guys have all the fun. But let's just stick them with the losses again and kind of see how long this goes. And if it works, yay. Awesome. We were levered. If something geopolitical happens, awesome. We were levered into it. If not, well, we were going down in flames anyway. And we might as well use, since the equity guys won't give us money, why don't we just use the high yield market money and we'll lose it for them. And that's great. I honestly, I can't necessarily, I'm obviously very happy they did it. This is wonderful. Can't blame them for doing it. If you're running that company, you probably only have a set of poor choices ahead of you. Yeah. And so, in for a dime, in for a dollar, let's go. And let's, if you're the CEO and other people are willing to let you gamble their money, I guess you probably just have to do it.
Yeah, and the earlier the better, probably, right? Because the seventh guy to do this, it's going to be faced with much worse options.
Yeah, there's probably some novelty to it. You don't want to be the guy who has to do this when these bonds are already trading at 7.
Yeah, that's right.
There's no recent high yield blow up for E&P. So you might as well get in line to be the first. And so that's, I think, the right move. And, that a lot of CEOs from the past are probably smiling right now, raising some glasses. I always think of the Dolphins every year when the last undefeated team in the NFL, like Buonaconti and those guys, always raise a glass of champagne. I imagine there's a group of CEOs in this space whose companies have already restructured that are raising champagne glasses today. Like, all right, this is great. We're very proud, and I'm excited. I'm excited to watch this. It'll be great to see. Yeah, I can't get the smile off my face from this. This is wonderful.
I think it's insane, Riley, before we pump the last bullet here into this corpse.
Yeah.
Just like to be long a takeout company and have it not be a positive catalyst is just a paradigm shift here. And I don't know if you agree. I think there is more consolidation coming.
There has to be.
The whole pitch is going to be G&A savings because there's no resource. It might be CapEx slowdown, and that's just not a compelling pitch. And if you're hitting a bid at 3x and taking somebody else's paper, probably, unless you get some more multi-billion-dollar debt deals, I mean, it's just a burden on the whole space.
It really is. It really is. But again, we'll see. I think you're right. These equities have, even though they're all down from the peaks, have hung in. I mean, the commodities markets turned hard on them last year, and the equity markets ignored it. And they're still, even though everything's down year to date, when you look at where the roller coaster started a few years ago, we still have had massive increases in TEB for all these guys. And so you've got an equity investor base that's still very upset, and the public market has inflated their multiples. And instead of saying like, oh, thank you, I'm getting out of here at 6 times instead of 3 times in the private market, they're all mad that oil didn't go to 150, and they're all mad that they're not through the all-time highs. And, I've said before on Twitter and here, like, sometimes the market bails you out in ways that you don't realize. The market has bailed you out in the public sector. It has bailed you out.
You just don't know it.
The private market is telling you you're supposed to be a lot lower. Yeah. And you're sitting here mad that you didn't go through the all-time highs. And again, anything can happen. Who knows? But wow, what's happening when real rubber hits the road is not, in my view, very friendly. And if these cash flows continue, we're going to have the LTM numbers after Q2, which is what all the debt guys use.
Yeah,
I'm telling you, I've said it before, there's not a lick of analysis being done on a high-yield desk about these names. They are just going to look LTM EBITDA. And what Civi's doing correctly here is probably selling these things before they have to do an LTM number that loses Q2 2022.
That's a good point. 10 days left.
And they're going to use that. And the high-yield markets will not care. But the next guy that does this on July 1 is probably going to have to say, well, here's what Q2 is looking like or what have you. And all of a sudden, these LTM numbers are going to start going the wrong way. And the debt market was, Civi did it. It was 0.6x. And the guy, but I mean, it was the same thing for me. Well, yeah, but you should have come 2 weeks earlier. Yeah. And it's that simple. Like, It sounds nuts and it sounds cynical, but that is the truth. That's the way that market is going to work.
Yeah.
And so, credit to them for just saying, look, let's use this LTM multiple while we can, and somebody's going to buy it. Yeah. Somebody's going to buy it. And obviously the bankers told them that, or else this wouldn't be getting done. And the market's telling them, because energy has been hanging out inside of the overall high yield index for almost a year and a half. So someone's going to take a shot at it. They're going to move the paper, and we're going to get to watch it and enjoy it. And I really I'm excited for this. And I think it's a wake-up call. Again, you were right a couple weeks ago, but what was still TBD is, let's get out of that basin. Let's take that dynamic out. I have a very hard time now listening to people say, well, that deal doesn't count. Novo was too small, $1.5 billion. That's a real size deal in Shell. And now we have 5. Like, at some point, the guys who are like, well, I don't want to pay attention to DJ. Novo was too small. Like, at some point, you got to say, look, guys, this is the M&A multiple. Sorry. Like, I'm not going to sit here at $5 billion and tell you that's not a real deal.
Yeah. Adjusted M&A now.
Yeah, like, oh, well, now they have to be 15, but there's like 3 guys that could do a $15 billion deal. So I think we now have a real market forming, and it's going to be interesting to see how the public market continues to try to levitate above the private market if they're successful in doing that. And so that should be a fun topic to continue to discuss. All right, moving on to another fun topic that we were very anxious to discuss here on the Diff. It's something, if you've followed me on Twitter or Substack, I've posted on a lot. Greg and I talk about this consistently over the months and years. We're going to try to dive into the WCS diff, Western Canadian Select. And Greg has put together a ton of stats for us. But first, just to demonstrate how important heavy sour oil is to the U.S. refining complex, I told Greg, and I did not show him the answers, that I was going to give him a little pop quiz based upon EIA data on the different pads in the U.S. and the overall U.S. So, Greg, are you ready?
Yeah, I don't know how I'll come out of this looking good, but go ahead, man.
That's okay. That's okay. Look at me. I haven't shaved in 2 weeks. I look awful. You can't possibly look worse than me on this podcast. I'm kind of hoping the video doesn't work. All right. So, latest data, end of March 2023.
Okay.
What is the average API in the whole U.S. refinery complex? That includes 1 through 5.
32.
Good guess. Latest was actually 33.39.
Man, wow.
And to remind folks, the spec on the WTI contract is 37 to 42. So obviously heavier than WTI.
Do you have that trend over time, John?
I do.
Give me a fun fact 10 years ago.
I'll give you a fun fact. So the data set that the the EIA provides us begins in January of 1985. So that's where I have to start because that's what provided to me. The minimum for the entire U.S., the minimum API in November of 2004 across that data set was 29.75.
Okay.
The max was January of 2021 at 33.62. So we are obviously at the very light end of the range overall. So let's go to sulfur. Nasty, filthy stuff. What do you think the latest? Now, keep in mind, obviously, I just told you. So that turned into an unintentional hint. I just told you that we're closer to the light end of the historical range than the heavier. But what do you, and the spec on WTI is 0.42.
That's what I was going to ask.
What do you think the latest aggregate sulfur level was as of March 2023?
0.6.
Oh, not even close. We're at 1.27.
Okay.
And
I should have quit
system-wide, it was very early in the data set. May of 85 was a 0.86. And the max was actually in 2014. And that kind of makes sense because Permian shale oil really took off after Bakken and some of the others. So max was 1.51 in Jan of 14. And right now we're hanging out at 1.27. Some other quick fun stuff. The lightest subset. So the APIs of all the pads, and then they give for 2 and 3 breakdowns of subpads. Actually, there's 1 as well. The lightest subset, which is intuitively makes sense, is Oklahoma, Kansas, and Missouri, right near Cushing. Unsurprisingly, right near the API, right near the specs of WTI. 40.65 in API, 0.4 sulfur, but we know they process some WCS and some other stuff there. Mm-hmm. And you have some West Texas sours that make it up. The heaviest is also in Pad 2, and this dovetails exactly into our conversation. The heaviest is the north of Pad 2. The Minnesota, Wisconsin, and the Dakotas subregion has a 28.38 with a 1.74 sulfur reading. So that is the heaviest subregion and the most sulfurous subregion.
Is it a coincidence that it's closest to the Canadian border?
It is not a coincidence at all.
Gotcha.
That is what they call in the biz a segue. Very, very good, Greg. That is awesome. So why are we focusing on this, folks? So WCS, and if as we've touched upon on this podcast and in writing and on Twitter, WCS and sour grades are extremely important to the U.S. refining system, as the stats tell you. So it's not as simple as, well, there's WTI, and that's what everyone puts in the refineries. And then I can look at NYMEX cracks, even though that's Oklahoma and New York. I'm going to pretend it's a real crack, and I can do all these different things. It's not complicated, but you do have to look under it's there's a whole lot of moving parts, and there's a lot of interesting things that can, in our view, will happen with WCS, which is, in our view, the single most important import grade, and Canada is our single most important import source for the U.S. refining sector and our U.S. oil market. And with the TMX pipeline, potentially, never count on anything occurring in Canada until it actually occurs, opening later in the year. There's some interesting stuff that is potentially going to happen with U.S. refining and the U.S. oil market. So, Greg, you sharpened your pencil. You did some work for us on what Canadian oil is going where, and help us set the stage for our listeners. Why is Canadian oil so important? And just as important, where the heck does it go?
All right. I'm going to give you double that, John. We'll do a quick run on.
This is why I hang out with you. It's just the value proposition. It never ends.
Overpromise, underdeliver.
I love it.
Okay, so we're going to talk about Canadian crudes, and then we're going to talk about TMX, and then we're going to try to figure out what it means. Okay, so horseshoes and hand grenades, U.S. imports, crude oil imports for the last couple years are in the ballpark of 5 million barrels a day, right? Over 3 of that is from Canada, our single largest source of crude imports. At this point, it is... it's over 50%. It's the biggest tranche by gravity. The EIA kindly separates crude imports by gravity, and the 20 to 25 API bucket that WCS falls in is far and away our largest. Okay, where does it go? The quick answer is pad 2. When you plot out the percent of crude used from Canada versus other sources by pad, it's a blip for most pads.
Yeah.
But in pad 2, the bulk of the Canadian imports end up being processed there. We're talking over 2.5 million barrels a day on a base that is refining between 3.5 and 4 million. So huge outsized exposure.
Yep.
On an absolute basis, the Pad 3 runs a few 100,000 barrels a day, but it's lost in an 8 million barrel a day market.
Of course.
Pad 1 has a little bit more exposure, 200,000 barrels a day on a less than million barrel a day market. Pad 5 and Pad 4, relatively higher exposure, but on an absolute basis, it's just not that material. So Pad 2 is far and away your biggest place of exposure.
Yep.
Now, the reason we're talking about it is because of the Trans Mountain Pipeline, right? Okay, here's some fun facts, some of which I did not know. I'm not ashamed to admit.
Fun facts. I love fun facts.
We've been waiting for years, I believe 5 at this point. We're at 6 now for the Trans Mountain Pipeline expansion. Yep. Meaning there's an original pipe in service that's been in service since 1953. The 700-mile pipeline connecting the Edmonton, Alberta hub to the west coast of Canada in the BC area. Cost $100 million to build initially. It's been expanded a couple times. And today the capacity stands at about 300,000 barrels a day. It's the only pipe bringing crude from the Western Canadian Sedimentary Basin to the west coast. The tariff on the line is about $3 to $5 a barrel, depending on the crude quality, what you're shipping through it. So the big news here is, of course, the expansion. Here's a quick overview on the expansion. They're going to effectively twin the pipe, running the whole distance, and expand the pipe capacity from 300,000 barrels a day up to about 900,000 barrels a day. Importantly, too, and I feel like this is a little bit lost in the news flow, is that they are expanding the marine berth as well.
Yes.
That's going to take Aframax capacity up from 5 vessels a month to 34.
I remember when they first proposed this, there were obviously this whole thing has been opposed by environmental groups in various forms for years and years and years. And when they first started talking about expanding the marine berths, you can't bring all these ships in, all the pollution. And it was something akin to, well, if it's one cruise ship, there are cruise ships going in and out of that bay for tourism all the time. And it's like one cruise ship. It was so ridiculous, but it is a key point. They needed to and have and are expanding takeaway capacity on the water.
Yeah, because actually the preponderance of the crude flowing through that line right now ends up on a little leg going into Northwest Washington, where PSX and MPC have refineries. So they're not exporting a whole lot of barrels at this point, but that's mainly because
good friends Holly have exposure up there now too.
Yeah, thank you. The project itself has been an unmitigated disaster. It was FID'd at $7.5 billion in 2017. This is after the Canadian government bought it from Kinder. The most recent cost estimate is $31 billion CAD, as if it matters.
That's almost like real money.
It's getting there. You read the Canadian rags, and it's fascinating. This is a big deal. A lot of finger pointing up there. Okay, so most recent update at the end of the first quarter, 82% complete, $24 billion cost incurred. They are targeting mechanical completion fourth quarter of this year, at which point they will bring startup line fill.
Yep.
Interestingly, you got to compare this to Enbridge's mainline system, right? The big 3 million barrel a day line coming into the U.S. right now. The new TMX expansion has 80% of its capacity signed with long-term deals, 15 to 20-year deals with the big producers up there, C&Q, Cenovus, IMO, MEG, etc. That's not a feature on the Enbridge mainline system.
No.
Let's see. The company estimates an annualized $2.4 billion in EBITDA after startup. They are planning to divest it after it comes online. It's going to be at a massive loss.
I heard Civitas is going to buy it.
Why not? I mean, if you're levering up
with debt,
yeah, why not?
It's going to be a wonder. It's going to be very synergistic.
It's understood they're going to lose tens of billions on it when they sell it, but they're not going to do that anytime soon. The toll on it looks like it's going to be $11 to $12 a barrel CAD. That's $8 to $9 in the US, and I imagine we're going to talk about that $8 to $9 a barrel.
Yes,
that's $8 to $9 USD, up from an original $4.50 a barrel when they FID'd it. There are cost escalators that will be passed through if it goes in $100 million cost tranches, depending on how much they actually cost. It finally costs to bring the line online. And the reason we care is that Enbridge, to their credit, has already said their mainline volumes will drop by several 100,000 barrels a day when this line comes up.
Mm-hmm.
And that means that it is going to disrupt the North American market for WCS. Yes. Take that baton, John, and run with it. What happens when this 600,000 barrel a day expansion comes online, starts line fill beginning late this year?
Oh, this is going to be fun. I love circularities, and this is going to be an iterative process that the market is going to have to figure out over months and perhaps years, depending on a couple of things. So when you think about the structure of how Canadian heavy comes in, and again, you mentioned this has been going on for years. The Keystone XL pipeline was blocked for years. Canadian producers have struggled with differential blowouts for well over a decade. And that has 100% accrued to the benefit of PED, primarily, not exclusively, but primarily PED 2 refiners. And the ones with massive leverage, guys like Phillips 66, Holly Frontier, CVI, guys that have committed pipeline capacity have been able to just enjoy such a discount on heavies. And that's been a huge part of what they then call capture and try to spin as some, leger demand management capability. It's really just they have pipe capacity and there's a whole bunch of stuff that's happened. So one of the bedrock assumptions of U.S. refining investing, and if you go on decks and mid-cycle this and mid-cycle that, which is just not correct, is that, mid-cycle WCS differential is supposed to be $18 a cushion. And everyone has just accepted it. And why? Because that's roughly what it costs if you can't get a barrel of oil in a pipeline to stick it on a train and get it to the Gulf Coast.
Marginal cost.
The marginal cost of shipping. Well, we don't really put a lot of Canadian crude on rail anymore. The last data we have on a monthly basis at the end of March was 71,000 barrels a day of rail going from Canada to the U.S. The number you mentioned, 590, is a lot larger than 71. And Enbridge is making those public statements because clearly they're having discussions with producers and saying, hey, when this line comes on, do you think you're going to have production to fill our pipe, or do you think you're more likely to move production off our pipe onto the other pipe? And clearly the initial answer, which if I was a Canadian oil E&P investor, I would be extremely happy to hear, is no, we're just going to move volumes over and we're going to let some excess pipeline capacity hang out over here.
Can we pause on that just for a second?
Yeah.
How long has the norm been to assume massive discounts for the Canadian producer? Like when was the last time there was spare capacity in Canadian egress?
I mean, you had moments when Line 9 came back, when they reversed Capline. You had some moments where, okay, awesome, we can get this diff tighter, but they've never, ever really hung on to it. It just hasn't happened. They have been unwilling to exercise the power that your data says they have over PADD 2. So every time they've gotten this thing into single digits, 15, when everything slowed down, they got inside of 10, 18, which was the ultimate blowout that their own government stopped. Mm-hmm. They took this WCS diff from minus 42 back to negative 10. But they've never really been willing to push it further than that. And as the numbers you showed us, they own PADD 2.
Yes.
Our PADD 2 collapses without Canadian oil. And yet for the better part of my life, Canadian producers have acted like they're actually employees of U.S. refiners. And they've done nothing but stamp checks and send them down to PSX and Holly Frontier and all these guys. When you look back in the 2010s to 2020 decade, Mid-Con refining, which showed no demand growth, is not in any sort of population center growth, was by far, when I've run my charts, the most profitable refining center in the world. I think all the Asian demand, all the growth is in Asia. All the oil growth is in Texas. Yes, you did have the Bakken, but all the oil growth's been in Texas. And mid-America, mid-con refining has been the best place to be. Best place to be. Now, as we like to say, nature abhors a vacuum, markets abhor an arbitrage. So we've been attacking it. It's just we've been impeding it. Keystone XL got blocked. TMX, they blocked it as long as they could. It sounds like, though, it's finally going to happen. So the implication, if they leave pipeline capacity open and don't follow past history to immediately shoot their own toes off, or that we then get to take that 18 and price it most likely off what that barrel is in the Pacific. Now, once you get those barrels to the water over there in that size at this time, because again, if you'd done this 10 years ago, you wouldn't have quite the refining capacity they have in Southeast Asia now. We now have a massive amount of complex refining capacity that's opened up in Asia. So now it becomes a very interesting dynamic. PADD 5 cracks are often set marginally by ANS oil. Now all of a sudden you're going to have nearly 600,000 barrels of WCS. And it's not going to have a Jones Act restriction. And it's something that Chinese and Korean refiners can easily absorb. They have the complexity in their operations to do it. So it's going to be interesting. The tariff is the tariff. At $8 to get to Cushing, $8 to get to the Pacific. You shouldn't really care. You should only care about what netback prices your consolidated production at the highest level. And ANS often trades well above Brent. ANS does have a bid for it in Asia, but obviously the PADD 5 market is still pretty strong. But if all of a sudden you can create a dynamic where those Asian producers, you look, Saudi's asking everybody to pay $3 above Dubai for OSP. Well, what if I can get WCS at Dubai plus anything? And depending on where that is, if all of a sudden I'm now pricing at Cushing minus a couple bucks, there has to be some sort of discount. CVI has often said they like it to run it when WCS is $6 or wider at Cushing. And they feel like that justifies the added cost of running it through their refining system, given it is so heavy and so sulfurous. Whatever that is, let's say it's $6 below Cushing, but it can get a higher bid in the Pacific, then that reprices everything from the Gulf on up. And now you have a dynamic where the PED 2 Canadian refiners, the PED 2 refiners of Canadian crude, are no longer the most profitable refining PED in literally the world for absolutely no reason. And all of a sudden, they are in open competition for their primary resource. And they don't have the infrastructure or the cost structure to compete with the guys in the Gulf. A lot of these refineries, you look at what Holly's running WCS through, these are smaller refineries than these mega refineries down on the Gulf Coast where Valero, Marathon, much lower cost per barrel. There's no way they can compete away Gulf Coast heavies there. If Chevron can resuscitate Venezuelan heavy and move that into the Gulf, all of a sudden Gulf can start sending even more stuff up to Group 3 and start to take that arbitrage away and start to take that market. EPD is reversing that pipeline into Utah. That's also just a bullseye into Holly's heart. If all of a sudden Valero and their friends can start sending summer gasoline from the Gulf, where they have a variety of options of oils, into Utah and start eroding those cost advantages. So this has the chance for PED 2 to be a seismic moment. And I joked on Twitter that PSX should pay every lobbyist anything they can to try to one last ditch to get this pipeline stopped. I mean, every dirty trick in the book. There should be crying babies. There should be puppies. There should be whatever you have to do if you're PSX to block this pipeline. You should be doing. Do it through a bank account in Geneva that can't be traced. Keep everyone's name off of it. But this is that serious for a massive amount of the U.S. refining capacity. And the flip side is if it's that positive for the U.S., somebody in Canada. And to the extent you have leverage to Canadian oil spreads, I think that's where these guys have to finally hold discipline. They have to say, look, here's our chance to exercise control over PED 2. We have ceded control for reasons that wouldn't make sense to anybody with a lick of common sense, but that's how we've operated for years. Let's not do it this time. Like I said, it should be very encouraging for Canadian investors in Canada. Some of them are American. Some of us haven't learned their lesson. But it should be encouraging to hear that they're telling Enbridge, we're going to start off letting some capacity go unused. And let's see how that feels, as opposed to, we're going to do everything we can to make sure that pipeline is filled and shoot ourselves in the foot again. So I don't think any of us really know the answer. My guess is, given how Saudi plays with the OSP in Southeast Asia, and given that the Southeast Asian market can easily, given the complexity of the refining system, continues to increase over there, it's going to try to find some life depending upon Dubai plus a spread in the Pacific Ocean, and then let that reprice what we get down in the U.S. Because they're just right now, there isn't the heavy sour to replace it, and there isn't the sweet to replace it. It's just not. It's, as you said, it's like 2/3 of PED 2. They don't have any options. And so it also kind of sucks for PED 2 customers. I think their gasoline and diesel is going to become much more expensive relative to the rest of the country than it has been over the past 15 years.
So then you're thinking, does that kind of come back at a high level? 600,000 barrel a day pipe capacity, call it 500 has been contracted with long-term contracts.
Yeah, so it's some cost.
Those guys are going to do, and those guys have signed up for capacity of 100 KBD. They're going to use it.
Of course. So and in some too, like even if they don't send barrels, it doesn't, on a variable cost basis, it doesn't affect your decision.
Yeah.
Your decision's a net back. If you have to pay the pipe $8 a barrel, whether you use it or not, then it's a fixed cost. It's not a variable cost. And so then you're just looking at the end of all of your pipes and going, who's got the best bid for my next barrel?
Yep.
And that's where you go. And you let the market set it. And they've never had the chance to do that. Now they do.
And now that this crude is going to enter the Pacific Basin, you're introducing some material volumes into an area that is actually competitive for these crudes, especially now with the OPEC cuts.
Of course.
That have been pushed through 24, at least by their own language.
I mean, just think of PADD 5 alone, right? PADD 5 is roughly a 2 million barrel a day crude input market. You're going to introduce, and PADD 5 actually, which I didn't read, PADD 5 is a California oil is very heavy, very sulfurous. PADD 5 refiners are very complex. They're very complex. And so if you look at where they are, they're at 29.46 average API, 1.3 sulfur. They can, and PSX uses it out there. They use it. Now, I don't think they're going to be the best bid because the PADD 5 market is a disaster for a variety of reasons. And I actually think this is going to make things worse. But you're introducing 30% more oil into PADD 5's world. And then China can eat, and Korea, 600,000 barrels. And like I said, they're going to be eager with the OSP games that Saudi plays. This gives them a chance to say, look, you don't want to send us Arab Light? We can take WCS. There's 600,000 barrels. So like, if we don't like your OSP, again, it's not perfect. Saudi's a massive producer, obviously, and OPEC's a massive provider of oil, but it's just yet another lever. And so you might even overpay for that marginal barrel of WCS if you think it helps you advantageously reprice a large suite of OPEC barrels.
Yeah.
The leverage that barrel is going to have in the Pacific Ocean, which is really starved for barrels, I think is going to be tremendous. And, you know, you're not getting any new stuff out of ANS until later in the decade when COP's done. You've got refiners on both sides of the ocean that can take it. I just think it's got the really interesting potential. Again, all predicated upon these guys not blowing their toes off. And history said they're blowing their toes off, but right now they're saying they don't want to. And so I think it's got really bad implications for PADD 2 refiners, potentially really good implications for Canadian producers.
So maybe we walk through that. So the first box to check is that these barrels are going to flow west. There is going to be a market. Yes. There's an appetite. So let's assume then that there is a disruption and the Canadian producers are going to flow west. And by flowing west, they are going to deprive PADD 2 of volumes that would have otherwise or have historically gone there. Let's call it, I don't know, 400,000 or 500,000 barrels a day. What does that mean? So now WCS has two outlets that are going to be competing against each other, and WCS really has only been competing against itself for the last 10 years. So we're going to assume then that the diff tightens, that at least the WCS relative to the WTI is going to tighten.
Well, I think the first move, I just think about where it's most expensive. The first move is actually probably in PADD 3. And I don't think it's going to be too much of a problem, especially if Chevron can bring back those Venezuelan barrels back quickly. As you said in your numbers and confirmed with kind of where they were on the March company level imports, you know, I had PADD 3 in March bringing in about 340,000 barrels, about 250 of which was heavy. Or sour, I should say. So it's most expensive to get it down there. So that's where the barrel leaves first. Yep. And so I do think that PADD 2 has a little bit of a buffer on that. The bigger problem is the next set of barrels. And since the guy losing those barrels is very complex and is surrounded by oil, and now we're bringing on more Gulf wells, we've got more, you know, even though it's not very sulfurous, we've got more mediums coming out of Guyana, we've got Brazil growing, we've got Venezuela coming back. He's got a menu. I mean, he doesn't want those barrels to go away, but he's got a menu. You have nothing.
Yep.
So he's not going to allow you to reprice WCS based upon him chasing it. He'll chase it to a point, but then he'll let it go.
Yep.
You know, and that's when PADD 2 goes, okay, what do we got? What do we got? I can't get to, first of all, if you're up north, you don't want to run max suite. You're probably not configured for that. Everyone has a little flexibility. And obviously all those guys up in Minnesota, Flint Hills and Marathon and all those guys, they take Bakken, but they're not, their API tells you they're not configured for 100% Bakken. And even if they were, it's not there. and you're not going to be able to bid sours out of the Gulf. Those guys are bigger and better and very well capitalized. And so I wouldn't want to get in a bidding war with Valero with, a sub $4 operating cost on the water. And I'm running a 180,000 barrel a day plant in Oklahoma, trying to outbid them for heavies. That's not going to happen. So I'm struggling with how they do anything in the short term other than just take the price. And then it goes to, well, what's the next thing? Look at what Cenovus has done. Cenovus bought Toledo's. They were 50-50 with BP. Toledo had a big fire. They're consolidating. Suncor is consolidating. From the U.S. refining perspective, it might make sense for them to say, look, we got to bite the bullet here. We got to try to buy this exposure. We got to do something. You mentioned Meg. Meg's a small, bite-sized company relative to some of these guys. That could be perfect for like, look, I don't know where this is going to go. I've got a ton of risk here. Meg's got pipe capacity out west. Their enterprise value, I'm looking at my screen right now, $7.4 billion Canadian. That's digestible. Those are the types of options. If I'm on the boardroom in a major U.S. refiner that's sitting here going, oh man, what are we going to do? Market still lets us put this $18 in our deck. We talk to these, we're the part of energy that has long only, so they don't ask us any questions. We don't want to have to deal with this. How are we going to insulate this? The market still has our earnings next year ridiculously high, even though a whole host of stuff's already going against us. I don't want to say it would be able to solve every problem, but one of the ways you do it right away is M&A. And, CVE, Suncor, some of these guys are already consolidating. You're going to have to find somebody that's long that diff and potentially do a deal with them or hope you can take them out. And I think that a lot of these guys have been independent and been on the right side of the trade on the refining side, are going to have to bite the bullet and potentially invest and basically buy that diff back. That economic rent is going to leave their enterprise value and have to go somewhere else. Because other than that, I don't see enough. I mean, we stalled Gulf production here in this country for way too long. Things are coming on, but nothing can grow fast enough at all to really replace these barrels right now. Where we grow production is in the light ends and in NGLs. And we're not really growing heavies. And Lord knows these are landlocked. PADD 2 is landlocked. So like you want to get Guyana, good luck. You got to go through a whole host of folks. You want to get anything out of any major offshore developments. You want to get more stuff from Brazil. Hey, there's a whole host of people in front of you. And so they've been living off this gift from Canada for so long. I just don't see a great option for them.
Yeah. So I don't know, maybe the best case scenario,
maybe I'm myopic here.
They're going to get, the diff is closing. So the best case scenario is that their margins, maybe reflected in the capture, are just going to be massively compressed relative to what we've become accustomed to the last 10 years. At best, they're still going to be able to process WCS, but they are no longer going to be buying at the really cheap relative price that they have been forever. And maybe somebody makes some sort of deal, either financial or with equity, to integrate all the way up the food chain, which we haven't seen in quite a while. We've seen the opposite. I mean, 20 years ago, we saw the opposite. That could be interesting, or they're just going to have to eat it, right?
Yeah, I don't see a way out of it for them. And like I said, Cenovus is doing something similar, though they would have been long the WCS diff. But you're right. I mean, and again, this is a theme we keep coming back to, how the integrated business model is enjoying a day in the sun again.
That's right.
As all these things change, because there's so many winners and losers now as new petchem and new refining capacity and pipes open. Being integrated allows you, Exxon obviously has WCS exposure and brings some into their refineries, but they have ownership up there and they have all these other things, and Chevron and all these guys who have offshore exposure, you don't have enough to blow you up on one thing, right? And that is what made them a drag, right? For so long. I mean, who wants to own an IOC when I can own a US refiner that Canada pays $30 a barrel to every day for absolutely no reason?
Yeah, just for
and I want leverage to that. I want leverage to that. Why would I buy an IOC when I could buy an inland Texas guy that gets $20 of Midland diff a day for no reason, strictly because U.S. shale guys drill without pipes. And they just pay us money.
Pricing power.
Why would I not?
It's materially inflecting from the advantage of the mid-con refiners who just woke up and got a check. And now it's going to be the producers, especially those who are not integrated with downstream refining.
Exactly.
You want to throw some names out there? Who's exposed on the PAD 2, maybe even PAD 5 side for refining?
Well, I mean, look, the 800-pound gorilla here is obviously PSX in terms of the leverage that it ripples through their system. I mean, they're roughly a little under 2 million barrel a day now, global refiner. And they're bringing in, they give you their sensitivities. And as I've said on my charts, I have my own version of what their sensitivities are. But just in March alone, I have them bringing in roughly 515,000 barrels a day from Canada, most of which is sour. So when you look at them, you go, holy crap. Now, that doesn't all go to their PAD 2 complex, and they obviously have JV ownership on certain things with guys like Synovus. But in terms of who's sitting here, and I think has the they've got so much to figure out in terms of the type of stuff they need to worry about. And they have lived off the Canadian oil differential for a very long time. And people have loved them for it. You know my favorite phrase in all of energy, stewards of capital. And they get called that all the time. It's a total crock. But they have a very, very interesting problem. When you look at where the refineries are, big PAD 2 exposure, big WCS exposure, big petchem exposure, which is going the wrong way, not subject here, but they have a very unique set of problems. All the ARBs that made them a darling in the last decade are now reversing on them. Holly Sinclair, obviously a big player. And they, through their Utah and their Oklahoma facilities, have bring in and now their PAD 5 up in Washington, which they acquired. They bring in, I've got them in March, bringing in about 140,000 barrels a day of oil from Canada. You start talking about refining systems with 700,000 barrels per day. Mm-hmm. Big number.
Yeah.
Big number.
When you're talking about just rough math, right? Like you're saying $10, it could be $10 a barrel cost loss or cost disadvantage evaporated overnight.
When you're talking about a business that with GRMs over time, again, everyone's looking at 2022 going, is that what it is? Like, no, that's not what it is. When you're talking about GRMs that are usually high single digit, low double digit, and then you have operating costs, and then you've got all these different things, there's not much room left.
Yeah.
There's not much room left. And then when you look at where they are in Utah, as EPD reverses that refined products pipe and they bring Canadian crude down into Utah, all of a sudden, double whammy, right? I've got Gulf Coast refiners taking away my profit center, or at least mitigating it on summer grade gasoline, while the Canadians are repricing my
getting
oil.
Hit on both sides.
It's getting hit on both sides. It's going to be, and you can see why they've been so panicked and trying to get out ahead of this, buying stuff, buying Sinclair, doing anything they can to get bigger, to kind of distract from this reality, because they lost the Midland diff. Now they're going to lose the WCS diff. And, they've been blowing tons of money on renewables where they have absolutely zero advantage. So they're running around like crazy. Again, given a ton of cash from Vlad Putin, but very, very difficult strategic problem. And MPC's massive. I think MPC has a lot of problems. They bring in a ton of Canadian oil as well. over 500,000 barrels a day in March. But they obviously also run a lot of Syncrude, which is a very rarely talked about oil grade that is absolutely phenomenal. Maybe I think it might be the best oil grade in the world. I know it's upgraded oil, so it's not technically out of the ground, but they also bring in a ton of heavy, but they're almost a 3 million barrel a day system. I think they've got a lot more levers they can pull. And obviously they've got those two massive machines on the Gulf Coast. I think they have a lot of problems, but it's not nearly the seismic event that I think it is for PSX and Dino in PAD 2 and in 2024. So those are the two entities that I think really have the most where they have to go, all right, this is not cyclical. And I get, I've heard me rant about mid-cycle, but just to give people a sense, and I'll post this on Twitter later, you don't have a mid-cycle with diffs. It doesn't exist. You don't have, once a pipe
is on or off.
A pipe is on or off. So everyone says, well, I'm buying this at mid-cycle. Well, if you look at the most important sweet oil diff in the country, where do we produce the most? Where do we produce the most sweet oil? And that's obviously in West Texas. So part of the boom in last decade was having to reroute sweet oil from Texas to Oklahoma and down to the coast. And that caused a ton of problems, and it was a huge boon for the Mid-Con refiners again. Well, Valero opened up Sunrise in 2018, which ended the ability to arbit into Cushing. Now we were overpiped. They started bringing it around. And then Gray Oak and all the other pipelines came in 2019. And so we now, as an example, if there's no cycle, the diff today is basically a shadow of its former self. To give you an example of how nuts it was in 2018, my Houston MEHC West Cushing got up to 10. Okay. But if I look and I say, okay, where was it Midland versus Houston? Because everyone usually quotes Cushing versus wherever you are. So Midland versus Houston hit a massive amount. That was $24 in August of 18, which is a staggering amount.
It's a WCS number.
It's a WCS number. It's a WCS number. This thing, if you look, and let's just obviously, because anything can happen on one day and a pipe goes down or whatever, but if you try to smooth this thing out and just do a 30-day moving average, all right, if in 2018, that peaked out around $20.70. Today, it's about 20 cents. It hasn't been above 60 cents since 2021. There's no cycle to diffs. Yeah. And so when the street says, where are you buying this name mid-cycle? That's if someone asks you that, don't listen to them.
So your point is,
because it just does
pipes. It's an instantaneous change, and it's structural.
It's structural,
and that seems to be lost on the market right now, because I think what you're telling me is that the market is not forecasting WCS diffs to close by $5-10 next year into perpetuity.
No. And they want to value these companies. They say, well, I want to buy this at a mid-cycle multiple. What the heck does that mean? There's no cycle in pipes.
But then, my contention, and we've talked about it before, but I'm going to have you beat me over the head with it. My contention is that the market is way hyper-focused on gasoline and distillate cracks for refining, and all but ignores the advantage that they have enjoyed from buying cheaper feedstocks, reflected in diffs.
1,000%. 1,000%. Nobody looks at sour cracks. No one does it. And if they do, they don't look at it till the end of the quarter. Yeah. All anyone talks about is NYMEX cracks. No one has any. Last week, it was like, how come refining stocks went up through the roof? Like, it depended where you were. PAD 5 got killed last week. Sour cracks had a nice week in the Gulf for the first time in forever. Just got to the bottom end of their Q1 range. We are tight sours. I mean, Valero has been showing us that Maya price just every week creeping in. Captures are going down. And so a massive part of refining is your ability to buy oil cheap to the benchmark. And that has been a huge source. It's been the biggest profit center for the U.S. refining space over the last 50.
Because this is the only place where that phenomenon exists, right? Internationally, like you're not able to buy crudes $15 off the benchmark.
Not really.
Not on a global market,
obviously.
Right?
The international market, I mean, who knows what internal transfer pricing Equinor is giving its own refineries, and there's national oil companies, and China does some but imports all their others. There's nothing like this. There's nothing like the fun of the U.S. market, where we have all these different oil prices internally and all these different refineries with different configurations that can take different products at different times. It really is a bit of a whirlwind. And if you're not careful, if you just paint it with a broad brush, again, it's not hard. It just can't be painted with a broad brush.
Yes.
It's simple math. You're the engineer. I'm not. If I can do this math, then it's doable. And so it's not that it's some crazy thing. You just have to go, okay. Like last week, Syncrude pops $3. Midcon was flat. So if you're celebrating Midcon and you're using Syncrude, your cracks are off $3 last week. NYMEX went bananas.
Yep.
Bananas. Shell shuts down a couple massive refineries unexpectedly, probably lifts a few cargoes to get themselves right on a few trades, and boom, NYMEX goes bananas. Wall Bayway's down. Just like this incredible soup. But okay, great. So what? Yeah, okay, we could throw the numbers. It happened. But is that everything? Is that everywhere? Is it calming down? Is it going to stay like that? I mean, probably not. It wasn't a change in demand. And so you have to look at what your refiner's running. And if you're an E&P, you got to know who the heck's buying your freaking oil. No one pays attention. It drives me nuts. We'll just produce it. Who's going to buy it? No idea. Never looked at a refiner in my life.
UCL1.
No idea. I'm actually proud of that. I put it on Twitter. I brag about how little I know about refining. And then petchem, oh my God, what the heck? I don't even want to hear that word again. And so it's going to be a really interesting 2024, and the race is going to be heavy crude replacement. And so I think the mix over the next 5 years, 7 years is going to have to be, go either acquire something that you'll never be able to get rid of the diff, but do some sort of deal, either buy somebody or do some sort of strategic partnership that allows you to insulate it, which means you're just going to front load all your costs. Whoever is doing that deal with you is going to take the NPV and just
lock them in.
Yeah, lock them in. Or how do you incentivize heavy growth? Probably in the 600,000 barrel a day range. And Chevron is trying to do it in Venezuela. And obviously we'll charge a fee for sourcing those barrels, as they should. We've got more stuff coming on in the Gulf. And we've got, even though it's not quite as sour and sulfurous, we've got, very high quality stuff coming online in Brazil and Guyana. But again, that has to get through the Gulf Coast to get to you in PET 2.
You're going to have to bid it up.
So you have a Hobson's choice. You're going to have to pay somebody. You're paying the guys north, or you're paying a toll to the guys south of you to allow that oil to come up. Either way, it's not going to you.
You want to throw a bone to the guys up north who we think could be relatively advantaged, maybe the less integrated ones?
Well, so I think, the one that seems to keep popping up, you mentioned, is Meg. That's one that always seems to be a favorite. Look, Canada, I'm not going to pretend to be an expert. I've done the work on a lot of those names. Man, the Canadian oil guys are a different breed. They have like 3-month-long arguments over $25 million junior miners that trade 10 shares a week. And, it's lunacy up there. I try to just stay, if I'm in Canada, like right now, I have a small CNQ position. I try to stay big and liquid and not try to overthink it. For me, the really interesting trade's on the refining side. I've been, frustrated with the way the Canadian management teams have over and over again shot themselves in the foot. I don't want to generate the ire of the Canadian world by saying this guy over that, because it's always, my brother played pond hockey with the CFO's cousin, and we know that, okay, great, phenomenal. I'm not getting into those. I'm not getting into those arguments with you. But I think if you look, obviously CVE has a high degree of integration now. It probably makes them a little less attractive. Suncor, I love the Syncrude asset, as I said, but Suncor, high degree of integration. It's more of find somebody big, liquid, whose shares are not controlled by some bright broker with a non-verifiable address and a Bitcoin account in El Salvador, because that feels like that's also 98% of the Canadian market. And just, if you want the long, stick there. And if you want to deal with the exchange rate risk, buy the ADR. If you just want to buy the Canadian dollar and not worry about that, buy the Canadian share. Whatever it is, whatever's in your risk tolerance, whatever's in your risk parameters under which you operate, that's where I'd go. Personally.
10 years ago, there were 10 U.S. E&Ps that had Canadian heavy exposure. Who's left?
And again, I love all roads lead to Devon. Like, man, Devon gave it away for a song. C&Q paid him nothing. Devon is now drilling their brains out in the Delaware, giving basically free money to Targa and all the other midstream guys. And now, C&Q sitting here going, okay, thanks for nothing for this asset. Now, look, I mean, the $1 million question, I don't know where oil is going to be. I'm relatively bearish because of what's going on at Petchem, but, I'm not. If oil could be 80, oil could be 40. I mean, we're talking about a diff as opposed to a flat price.
This is just a relative improvement.
This is a relative. So that's not a guarantee, obviously, that any stock will go up. I mean, obviously, a better diff on a really crappy oil price still results in a crappy earnings stream. And a lot of these guys, if you have the sands, you've got what I find to be very interesting leverage, but leverage works both ways, right? So if you have a high cost and that flat price goes down, it could be kind of painful. But man, now we want to talk about a juicy scenario. Dare to dream, Greg. Oil at 50. This pipe comes on, and these guys are shutting in production. The diff will go bananas.
It sure
that
would.
Would be the pipe.
It sure would, man.
Oh, I mean, as much as a debt-fueled Civitas acquisition can make me smile, $50 oil, C&Q saying they're withholding barrels while pipes are on, and hedge refiners can't find heavies.
This is what the old COS was built for, man. Like your Uber tour, $60 per barrel OPEC until Suncor took them out. The answer was Conoco. Conoco has a pretty decent oil sands exposure now.
They do.
And that's it. Everybody else punted. Marathon, Devon, you name it. They're all gone.
Yeah, and the integrated side. And the Exxon has exposure, BP, but again, BP has Whiting, and they bring a ton of Canadian to their refinery system, but BP's so massive, you're not getting the leverage to this that you get in all.
But you're right. Like as far as pure exposure to the thematic,
Conoco has some exposure. It doesn't nearly offset.
Correct.
Their Delaware crack.
Correct.
But it's there.
Now it's bigger because they preempted Suncor and they're buying the Total piece as well, so they have more. Yes. But you're right. Like the way to play the thematic is mid-con refining. If you want a little relative play, should help your upstream non-integrated names, regardless of price, relative to other players. Somebody's going to be getting a gift on realizations. Now, whether or not the flat price goes up or down, don't know.
Another episode entirely, man. Another episode entirely. Right. Well, dude, this was fantastic. I hope people found this helpful. I love geeking out on this stuff, and we hope that you guys did too. Hopefully, and again, we've this is our third episode. We really appreciate anybody that's been sticking with us and listening. Hopefully, you're finding this helpful. Hope we can bring a lot more of this to you guys going forward. Please subscribe to the Primary Vision Network here on YouTube or wherever you're listening to this. And I'm John Riley, my partner Greg Bordelon here, and this has been The Diff, and we look forward to seeing you again real soon.